What's going on, guys? Hamilton here with the Trading Initiative, and in this week's review we're going to do something completely different, something that I haven't normally actually produced in terms of a YouTube video. Normally we do this stuff inside of Discord every Sunday, but I'm going to try to prepare a short video here, about 5 to 7 minutes, talking through last week's action and trying to build a thesis coming into this week, March 6th through March 10th. If you like this type of content, please like and subscribe. Let me know in the comments below if there's anything you'd like for me to change or add in towards this type of analysis. And let's go ahead and get started. This is going to be rapid fire. We're going to start off with intermarket analysis. This is very important inside of TTI. Realistically, we're just looking at a basket of gigantic assets that we like to keep our eyes on. And in this case, 1 week return, three month return, 6 month return, how far off they are from the 200-day, or excuse me, the simple moving averages, the 20-day, 50-day, 200-day, etc. RSI. Last week, going into Friday, we saw extreme weakness in basically anything except for the dollar and yields. But Friday, we had such a powerful reversal that Friday, a lot of things that were down heading into Friday morning session popped up huge and closed. And that is key going into this upcoming week. Which of those areas is going to continue the thrust that was started on Friday? Which ones are going to continue to hit higher highs? As of Friday's close, crude did end up closing 5% up, commodities up, emerging markets up. These were areas of the market that were lacking going into Friday that absolutely surged after Friday's session was over. Copper, the Qs, small caps, etc. Bitcoin being a huge drawdown, also partially because it's trading over the weekend. But what I want to focus on really quick are the bonds, right? Bonds are absolutely getting thrashed here. We're going to see in a second the yields are breaking out, trying to sustain their rally. The dollar is pressing up into an aggressive area. But as of right now, stocks responded very well on Friday, and specifically some of the more offensive areas of the market. And in particular, what we're going to look at right now is this mid-cap, MDY. Mid-cap's up 11.42% over the last 6 months. We're going to go ahead and look at this on an absolute basis after this chart, the factor analysis. We're going to go ahead and break down market caps and then tranche them out by value growth and core. Going back 3 months here, what I want to focus on is this mid-cap value. Mid-caps have been outperforming going back to September, I believe, of last year. This is a risk-on area of the market, right? Mid-caps, small caps, as you can see, IWO is number 2. That's your small cap growth over the last 3 months. This is a very risk-on mentality of having mid-caps and small caps outperform, and something that we kept an eye on throughout the month of February, which was seasonally weak, right? Stocks came down, but we kind of expected them to come down. Seasonally, February is a month where stocks like to sell off. We wanted to keep our eyes on this market cap analysis portion of our system and see how did the risk on areas of the market respond. As you can see, mid caps and small caps, specifically growth, held up very well during the drawdown. This to us was a key factor in why we did not short the market with size, which ended up saving us because Friday blew shorts out of the water, and why we kept some of the longs that we had opened up in January, and these things are up multiple hundreds of percent still, even with the drawdown, and we're looking to continue this oscillation to the upside. So let's actually dive into mid caps. What makes this so appealing? Well, you can see we stamped out those October lows, and this is pretty common across all of the different major indexes, right? Nearly every major index found that low in October, but what makes these mid caps special is that they're leading the market right now. Like we said, up 11.4%, came down and retested a very logical level of resistance turned support. But what's key here in my mind is this RSI. The RSI never broke 50 even during the pullback. This means that the bullish momentum that is coming into mid caps right now, specifically US domestic mid caps, is crazy. The market does not want to sell these for whatever reason. It's not up for us to decide why. It's just up for us to understand that it's happening and to try to take advantage of it the best we can. And we are inside of TTI. We are long multiple mid-cap names, and we have been for a while. So it makes total sense that MDY came back, retested previous resistance, now turned support. The bullish momentum regime is still holding up. Volume is still very high. And that 200-day moving average is starting to slope to the upside. Very, very good look for mid caps. But let's go ahead and look at all of the stocks across the market. We can use RSP, which is the equal weighted version of the SPY, right? So most stocks are moving up and to the right. And what we're looking at here is if you think of SPY as a non-equal weighted ETF, meaning that the biggest stocks own the most weight within the ETF, RSP is actually going to make Apple the exact same weighting as the bottom company in the S&P 500, the smallest one that's listed in the S&P 500. So you're not going to get the big boys at the top pulling the index up or potentially dragging it down depending on performance. It's a better overall snapshot of the market. And what are we seeing here with RSP? we're seeing that most stocks are still heading up and to the right, even with this drawdown that we just experienced over an entire month of February. We came up, we retested these August highs, we actually broke slightly above them in January, came back down, oscillated, placed in a higher high, a higher low, and we are on our way to potentially breaking out again solidly above those August highs and into higher highs. Once again, most stocks are moving up and to the right even during the drawdown. Let's go ahead and niche down into just growth stocks. QQEW, same idea. Equal weighted NASDAQ, right? So most growth stocks are outperforming right now. Up and to the right, we have this beautiful base that we're looking to break out of over those August highs, and we held the 50 RSI once again. The market right now is rewarding growth stocks, specifically stocks that are already breaking above their 200-day moving average and that have that 200-day moving average starting to curl to the upside, just like you're seeing with QQEW. Even during the crazy pullback we got in February, the 200-day moving average is still starting to curl to the upside. Previous resistance areas are acting as support. None of this is mind-blowing, right? We expected this type of stuff to happen in February, and it happened. Now, having said that, there are two very big headwinds coming in towards the equity market. The dollar DXY pressing up in towards that 105 area is a potential higher high in a broader pullback. That is bad for stocks. We break above 105 and start really pushing up in towards 106, 107. This is a major headwind for stocks. We have this level inside of TTI. We're watching this level every single day, and the dollar has broken above it a few times. But for whatever reason, it's unable to sustain itself up there. If we do flip that 105 area and start trending up and to the right on that, we think that it's going to be incredibly hard for stocks to continue the type of rally that they've experienced over the last 3 months, at least year to date, because most stocks are still up year to date, even with February's pullback. Once again, yields as well. Now, yields already did break, right? We were sitting at 4 for a majority of Friday, but then we popped back down towards the end of the market. This is a very big headwind, once again, for stocks. If yields are breaking out and bonds are selling off, that correlation between bonds and stocks right now, very strong. If bonds are selling off, we would expect stocks to start to sell off, or at the very minimum, not get bought with the same type of vigor. So above 105 in the Dixie, we are very cautious about stocks. Above 4% on the U.S. 10-year yield, we're cautious with stocks, and we're knocking on the door right now. Could this potentially be areas of resistance for an oscillation to the downside? Absolutely could. We don't know. We're not trying to predict, but we do understand that these are areas of influence, and we want to be aware of where we are trading north or south of those areas. Even during the February pullback, I want you to focus on the percentage of the S&P 500 stocks above their 200-day moving average. As of right now, over 60% of the S&P 500 is trading above the 200-day moving average, even with February's pullback. A majority of the market is trading north of the 200-day moving average. Market breadth did not deteriorate at the same rate as everybody would want you to believe. We had pullbacks. We had stocks that capitulated. Yes, classic, right? Indexes fell. Stocks capitulated across support levels, but the majority of the market continued to hold itself up. And as of right now, off Friday's bounce, over 60% of the S&P 500 is above their 200-day moving average, and we are potentially starting to place a higher low for another oscillation to the upside. If a majority of the stocks are already above the 200-day moving average and the indexes are starting to bounce, what do you think this is going to look like in a couple weeks? Probably a lot more. High beta versus low beta names. Just want to point out that offense is winning here. The high beta names over to the left here, SPHB, you can see a nice higher high, oscillation to the upside, higher high, higher low, higher high, higher low. We see the RSI has held the 50 the entire year. Bullish momentum regime. We love to see this. On the right-hand side, SPLV, low beta names. These are not performing at the same type of vigor that their high beta cousins are, right? RSI shows a bearish momentum regime. This simply means that the market wants to own high beta names, which are generally going to be the riskier assets in the market. They move more in terms of the beta against the index, obviously SPY. So the market right now is wanting to own the names that move more on an intraday basis than they do names that aren't moving more. And generally, this is a very risk-on market indicator. All right. Few more things and we'll call it a night here. IWF growth versus IWD value. I just once again wanted to point out the reference. We saw high beta, we saw low volatility. Now we're looking at growth versus value. Where is the market rewarding risk right now? It's growth names. Growth names are outperforming value names. They have for a majority of the year. And if we are starting to break to the upside again on the indexes led by mids and smalls, specifically in growth, which we saw with MDY, IWO, and then once again with QQEW. We would expect this ratio to hold or potentially even expand, growth outperforming value potentially even more. As long as growth is outperforming value, you're going to want to have a majority of your allocation in towards those growth areas of the market, because that's where the most returns potentially could be, right? On an absolute basis, IWF versus IWD, you can see now this is great that both of the charts are moving up and to the right. That's going to be awesome for indexes, obviously, because the more sectors that are performing well in an uptrend, the better, the healthier the index is going to look. But growth is outperforming value over the same time frame here. And that's why we want to continually look for growth opportunities in the market. I don't want to say that we're not trading anything value related. There are some spots in value that we're going to look at in 1 second that do look great, but overwhelmingly growth is the area that we want to be trading right now, because that's where risk is being rewarded. So we're going to finish up here with U.S. sector and U.S. industry performance. And this is where I was just talking about we want to potentially get long value. So we go back 3 months. I didn't want to use year to date because I wanted to get some data from the end of 2022. Communications is leading here. Communications is a very risk-on area of the market. Think Google, Facebook, telecom names, etc. Followed by XLK, which is your tech, your Amazon, your Apple, your software names, your internet names, etc. These are the two best performing sectors this year, and it feels like it. If you've been trading tech, and we're going to lump, Google and Facebook and everything in with tech because most people do, even though it's not right. But these big, growth names that people like to trade have been performing very well this year. And we can see that reflected within their sector ETFs. Two areas of the market that have not gotten the same sort of attention but are performing well, industrials and materials, specifically on Friday. The thrust in materials was insane. Copper, steel stocks, coal stocks sitting at, some of them are at all-time highs right now, coal. These are value areas of the market that most people are overlooking. So if you want to get a leg up, you want to search for potentially some stocks that maybe not a lot of people are invested in or trading right now, look at your industrials, look at your materials, make sure they have volume on the chain to actually support the trade, but then go look at them, find them, trade them, right? So we want to be trading anything north of SPY here. SPY's down 0.21 over the last 3 months. We want to be looking at names above, but realistically, a majority of us are going to be within TTI, XLC, XLK, and then XLY as well. Obviously, Tesla's dragging down XLY here and Amazon, but the broader consumer discretionary sector looks great. Last slide here, U.S. industry performance. Recession's coming. The housing market's about to blow up. Yields are going crazy. Somebody tell me why ITB, your home building ETF, is up the most over the last 3 months, 12.05%, and in a relative uptrend after the drawdown in February. I have no idea. It's not up for us to understand why. The economy and the stock market are two completely different things. As soon as you understand that, you'll start making more money. Semiconductors, though, is where we are invested heavily right now, trading semiconductor names. ALGM up over 1,000% on the position. NVIDIA, AVGO, a couple other names as well. Semis are up 10%. This is a hot part of the market right now. We want to continue to trade these. XME, your metals and mining, I was just talking about on Friday. These popped up huge. You can see the crazy thrust move over the last few trading sessions. XME, look those up. FDN and IGV, rounding up your XLK names, right? Semiconductors, internet names, software names. That's where a majority of our cash is. And as of right now, we're not invested or trading anything sub SPY right now. TAN and PBW, nice thrust moves, but we really want to see them rally consistently, not just a single name in the space. In terms of TAN, it would be First Solar right at that all-time high. Right now, we're seeing broad-based industry performance in semis, internet, software. They're working well. Our trades are working well. We don't see any reason why we should stop trading those names. Something that we're going to look at as a group. XME, though, we probably want to grab some exposure in metals and mining, considering the thrust move over Thursday and Friday's session. That's going to pop up on a lot of our scans tonight. All right, guys. So listen, if you're a 9-to-5er, if you don't have enough time to trade, or if you just don't like day trading, you prefer to sit in trades longer, this is what we do. We built an entire system to help guys scan, trade, make good decisions. We have an entire framework. The TTI trading system is there to help you. Our community, you can trade with us live every single day. Links are in the description. Check us out if that's something that you think would benefit you. Once again, I appreciate you. Like and subscribe. I'll see you in the next video.